Well, Wilson Asset Management's Geoff Wilson has been hypercritical of Labor's proposed super tax changes, Division 296, which we discussed earlier for the upteenth time, I must say. Now, Mr. Wilson is particularly put off by the tax on unrealized gains. It seems to be a consensus amongst those that we speak with here. So the question is there a better way? WAM founder and chair Geoff Wilson joins me now. Geoff, welcome back to AusBiz. Thank you so much for joining us. So,
good to be here, Nadine.
What is your idea how this legislation can be improved? Because it seems the consensus is that it should be tinkered with.
Yeah, the unfortunate thing is, when Treasury brought the options to the government, the four options, they actually picked an option that will be very negative for the Australian economy, very negative for investing, a breach of effectively social contract for people that have got their money in superannuation, and some people have got their money in superannuation for 40 to 50 odd years until they can get access to it. The proposal that we put up, and this is to the economic roundtable that's going to be held later in August, was, from our perspective, is the pool of capital in superannuation, particularly the over $1 trillion in the self-managed super sector, that is very important, patient, long-term investment capital that is needed in Australia. And if you bring in a tax on unrealised gains in superannuation, then you will lose the ability to get access to that trillions of dollars of patient long-term capital. So the proposal we put forward was actually to tax realised gains, and I can go through why it's so simple moving from unrealised to unrealised. It's actually not that simple, but how it can be done, and actually tax realised gains progressively above the $3 million threshold that they're talking about, up until the $20 million threshold, and tax them starting at 15%, the realised gains, and being a progressive tax up to 25%. And we actually will raise, there'll be more money raised than the current government strategy of taxing unrealised gains. Now, with our proposal, we've also got a tax offset there, which is the cost of setting up the systems, because currently the industry funds and the union funds don't have the systems to be able to work out on a per member basis what the realised gains are. Mm-hmm. So that'll cost $90 million to set it up initially, and then probably about $40 to $50 million a year. And so we've got a tax offset, so no one is worse off, and it still brings in $2.4 billion. So yes, everyone knows.
So that's it, Geoff. I mean, your plan relies on taxing only realised gains, which are less predictable from year to year. So how does your proposed model ensure that we've got stable, reliable revenue for the budget, something that the government argues Division 296 will do?
Well, I mean, just to start off, you said you've had a number of people that have been on this program that have been critical of taxing unrealised gains. And I think anyone in Australia, once you explain it to them, that you're having to pay tax on a profit that may never eventuate, they understand it's, some people call it sanity, some people call it criminal. To me, it's very illogical. In terms of whether it's realised gains or unrealised gains, there's always assumptions, and that's and we've used the same assumptions that the government have used to assess that the unrealised gains would raise $2.3 billion. We've used the same analysis and expectations in terms of turnover and growth in assets to come up with our $2.4 billion. So to me, it's the same. We're using exactly the same numbers. Obviously, if you assume that the returns are, we both assume the returns are about 6%. If you assume the returns are similar to what they were last year, for super funds about 9.5%, then you're talking about, I think on our numbers, you're raising $3.8 billion. So obviously it's very tied into the overall growth in assets.
I'd like, Geoff, for you to explain your thinking about protecting that patient capital, that your changes will help protect that patient capital to help improve productivity, encourage economic growth and innovation in Australia, which we know has been suffering. How do you see the sort of progressive nature of your submission also potentially, testing the limits of that patient capital?
Well, effectively, everyone understands, paying tax on a realised gain, and I think unfortunately not everyone understands the negative impact of paying tax on an unrealised gain, and in terms of the $1.1 trillion that's in self-managed super funds, a lot of that capital is used to support startup companies when they're at their most vulnerable and when they require capital, and when capital is so much more valuable to them. I was down at a technology hub about a month ago, and they were telling me that probably 50 to 60% of the money that they get for their small startup Australian companies, which we all know small companies and medium-sized companies are the lifeblood of the Australian economy. But pretty much 50 to 60% of the money they get for that funding to support those type of companies comes from the self-managed super fund sector. Now, and when I was talking to them, they said since this has been announced, they've actually had there's no access to money from that sector, because why would you take the risk that you might make like 10 or 20 times your money? And the value of the assets that you invest in your super fund in that high risk area might go up significantly. You're not able to sell them, and you pay tax on them, and then the value of those unlisted companies doesn't end up coming to fruition, and you've had this big tax liability, and you're worse off. Particularly one area that I've had a lot of pushback in terms of taxing unrealised gains is the crypto and Bitcoin world. I know some, I've met over the last couple of months on this sort of discussion, that some people that are big investors in Bitcoin that have actually left Australia because they can't take the risk of if they've invested in their super fund, and some have significantly, that if Bitcoin falls, and each time it's fallen about 80%, when it's at a big drawdown, they can't afford a situation that they have to pay tax, and then the value of the assets falls significantly, and they don't have the cash to pay the tax. It's
such a vexed issue. But your proposal for some really large super balances has put up, a 25% tax on realized gains. Do you think that will also discourage some of those same investors to pull money out of the system or shift assets elsewhere?
I mean, there's always a risk. There's no doubt. We've seen it globally. We've seen it in Australia. With cigarettes, you change the tax and the behaviour changes. What we were trying to find is the most equitable way, and I think everyone understands a progressive tax. So to me, that's what we were trying to come up with, a solution that would work best for everyone. Unfortunately, this tax on unrealised gains, which comes into effect for the current year we're in, and if you've got more than $3 million in your self-managed super fund at June 2026, you'll be paying this tax. If the government brings it in, there's already been a lot of movement in terms of people, readjusting, their super funds, and particularly, looking at just hot, yielding investments rather than, letting that $1 trillion, do what it should do, and improve productivity by, allowing it to be patient, long-term, supporting capital.
Geoff, what has the response been so far as you can gauge? How hopeful, how positive are you that there will be some sort of a change made to this Division 296, which could lead to, as you say, more equitable potentially outcomes for not just the those that have their money and high balances in super, but also for the budget bottom line?
To me, anyone having this explained to them, whether you're on Liberal, Greens, or Labor, they all agree that it's bad policy. It's an illogical, some call it an insane tax. So they all agree that taxing unrealised gains. What everyone agrees is that people with large balances in superannuation too, they should be paying a higher tax, and that's what our proposal is significantly more equitable than taxing unrealised gains. The challenging thing is, the government has been talking about, it only impacts 0.5% of the Australian population. That's in terms of the people that it impacts in terms of paying the tax. And as it's not indexed, then the 25-year-old nurse or social worker, they will be paying the tax on unrealised gains by the time they retire, with inflation. And the challenging thing that people don't realise is it's the negative impact that investment pool of capital, the trillions of dollars that changes, and so effectively it'll impact every Australian. We won't have funding for maybe the Canvas or the Atlassians, some of the great technology, or the Afterpays, the technology Australian success stories. To me that's the real challenge, and the numbers that we've done, as you said, for every action there's an equal and opposite reaction. The government's talking about bringing in $2.3 trillion. The negative impact on the economy, we've done a discussion paper, we did a couple of months ago, and it's negative $94.5 billion in terms of negative impact on the economy.